Good morning, everyone. I'm David Marcus, host of Drinks with the Deal, and today I'm joined by Erik Lee, a professor of finance at the University of Iowa and author of the new book, Catching Cheats, Everyday Forensics to Unmask, business fraud. Erik, thanks for being here today.
Well, it's a pleasure. To be surrounded by so many lawyers, it's almost a little intimidating, I have to say.
So, to start, tell us a little bit about yourself and maybe the core of the book, which is your role in uncovering the options backdating practice that was very prevalent in the Valley in the late 90s and early aughts.
Yeah, it's a long story. To be fair, the book is about more than just the backdating story, but that's sort of my claim to fame back in the days. And since then, the area has developed quite a bit. But the backdating story started back a couple of decades ago. I was digging into data on stock option grants to executives. And I wasn't really looking for backdating or any fraud, but I was rather looking to see how these grants would affect behavior among executives. Because that was at the time when these options were getting very, very popular. So we needed more evidence on that. So I sort of hesitated when I saw what happened to the stock prices around these grants. And I saw that the price patterns were so pronounced that I couldn't just do anything but stare at the graph, and I had to do something with this itself. So that's how that got started. And it's a long story after that because, hey, academia moves very slowly. I was looking at that graph for months until I finally figured out what happened. And I realized that what people were doing was that they were simply granting themselves options, but picking a date from the past when the stock price was particularly low, so they can lock in a low exercise price. Brilliant and powerful, and so simple that anyone could figure this out for themselves.
And then your research, you shared your research with the reporters at the Wall Street Journal who broke the story and who ultimately won a Pulitzer Prize for it, and affected behavior in corporate America.
Yeah, it moved slowly. I remember reading a story in the journal at the time that the SEC was looking into grants, but they were suspecting that some people were using inside information. We talked about information leaks here on the early panel. They were suspecting that people were using inside information and predicting what the patterns would be in the prices, and they would grant themselves options accordingly. For example, if they thought that the price would drop in the near future, they would just wait and grant themselves options after that. So after reading that story, I contacted the SEC, and I said, I don't think that's what's going on. And in that case, they actually got interested. And usually when they contact the SEC, they just say, yeah, we'll look into it. But in that case, they got very interested. And they asked me for some data. So I was happy to send them some data. And then they basically said, we'll take it from here for a while. And they looked into the data and took about a half a year, and I read another article in the journal, this time about an SEC investigation of backdating. And at that time, I contacted the Wall Street Journal, Mark Maremount at the journal, and I told him that there's a whole lot more here. He started by first writing up an article on academic evidence on this, and then he came back and he said, I think we got more here. And so he also asked for data. So I sent him some data, and then he put a team together, and that team worked on this issue for about a half a year. And then in the spring of 2006, they published an article called The Perfect Payday. It was a widely influential article. It might just be the most influential article that the journal has ever had. It was, I remember, it was in the weekend journal with lots of graphs, looking at individual companies, zooming in on certain grants, and outing essentially a handful of companies and executives. And then it just rolled on from there They continued with that team for the next year, company after company being outed, executives being fired, and the SEC started their massive investigation and so on. And then finally, the Pulitzer Prize.
And then tell us a little bit about the book and also about what interests you about financial fraud. It's funny, I was talking last night to Frank Partnoy, who's a professor at the law school at Berkeley, and who used to host a fraud fest where people would come together and look at fraud from an academic perspective. And in a sense, this book is it's a literary version of Fraud Fest. So what interests you about fraud?
Yeah, well, it's funny because I actually read Frank Partnoy's books, the early books, decades ago. In fact, I liked the book Infectious Greed so much when I was at William & Mary decades ago that I bought another copy to give to my favorite colleague there. And so, yeah, I've always been fascinated by it. And aren't we all? I mean, you look around, you look at all the documentaries out there, you look at the true crime enthusiasts. Yeah, I think we're all fascinated by this. I'm certainly fascinated by it. And in all my research, there's always been these conflicts between players, and sometimes these conflicts lead to fraud. So yeah, I think it's part of our DNA, certainly part of my DNA, and I just find it fascinating.
And so as you look at the business and financial world today, what areas or practices make you raise your eyebrows with suspicion?
Yeah, that's a very good question. And looking at this audience, I feel like you guys are more into the weeds of this. You know, I'm sitting in the college town, reaching out to people, talking to people, so I get some sense of what's going on. I read the Journal and the Times and so on carefully. But what I gather is that there's a lot of things happening in the private equity sector these days. And it's simply because there's poor disclosure in that arena and poor regulation, especially when it comes to assessing values. We've seen some scandals recently. We saw First Brands, of course, that Ohio company, go bankrupt, and there seems to be a lot of shenanigans in that company, with the company having double factored. They have probably collateralized assets twice and so on. There was another company I looked at recently called, what was it called? Sits Auto Watch or something, where a lot of these private credit firms were trying to assess the value of their claims in the company, and they all had different values. And even as the company was going downhill, a lot of these companies were not updating the values. So I think that's a big problem, and I think part of that is intentional. I think it's intentional first because they want to reduce the volatility of the assets, something that some people call volatility laundering.
Right.
And I think also in a lot of cases you want to bring in new investors. So you jack up the value of the assets. Another term that has come about recently is NAV squeezing, where you have one private equity firm buying maybe some assets from another firm. Then it's going to be a third party assessing that value. And so maybe that value is, I don't know, $100 right now. You might still be able to buy the assets at a discount to that, maybe at $70 million. But even as you turn around and bring that on your books, and you just bought that and clearly the market value is 70, you are allowed to put down a value of 100, which is crazy to me. And yeah, they disclose some of this stuff, but not very carefully. And a lot of these firms, a lot of private equity firms, they bury a lot of this information down in footnotes, making it almost impossible to figure out. So there was the journalist John Wiley at the Journal, who also was working on Enron many years ago. He had some pretty cool pictures in the Journal. It was about a month or two ago. We just had a picture of the footnote, just the footnote. And the footnote for this private equity firm went on for 3 pages, with just numbers of what the firm had paid for various types of assets. They could easily have been included in the table, so you can match up what the acquisition cost was compared to the reported value. But clearly, the company didn't want to make it that easy for us to figure out, and so it turned out to be impossible to match up the numbers.
So as private equity firms are obviously trying to access money from individual investors. How do you respond to that? And are any of the Lee family retirement funds going to be directed toward private equity focused investments targeted at individual investors?
Yeah, no, I think I'm going to stay away from that. I think I'm going to stay away from a lot of alternative assets. My view on this is that when a lot of these things go down to the level of the individual investor, they have problems selling it. And I think that's what's going on here. There's an excess supply of these types of instruments. In the early days, when Dave Swanson at Yale and so on was starting to invest in this, there was probably the liquidity premium for holding that stuff. I think that too many people copied that style. And at this point, there's not much value left. And so again, when they're pushing it on us, I don't think it's a good thing. So I hope it stays away. I think there will be a lot of lawsuits that will happen if it sneaks into our portfolio. But if it ends up there, it's probably going through some target date fund or something. So there'll be a lot of people who have no idea that end up holding a lot of the private equity.
Talk a little bit about crypto. What you see when you look at the crypto and Bitcoin sector.
Well, yeah, I'm not a specialist on that. When I look at that sector, having talked to some people who are experts in that sector, I understand that technology has a lot of promise. But at the same time, also understand that it's an incredibly inefficient technology. And that bothers me because you see these data centers being built over the place.
Right.
Even in Iowa these days. And some of these small towns, they invite them in thinking that they're going to create jobs and opportunities and so on. I don't think they do. I think
it's like a contemporary version of Music Man, which, as I remember, was set in Iowa.
Yeah. So on that basis alone, the environmental impact, the footprint alone, I think is a problem with that sector. And beyond that, what I've seen so far is that it's basically had two platforms. One is that it has facilitated a lot of fraud on the deep web and so on. And obviously that's not good. And on the other hand, it has allowed a lot of people to just speculate. But it's essentially a zero-sum game, right? That we don't even know what these things are worth. So we just sort of place some value on it, and people play with back and forth. I don't have that much sympathy for those people who lose money in that game, as long as they understand what they're doing. So in that sense, I think it's pretty innocuous. So I think the greater crime, at least for humanity, is the environmental footprint. But I might be wrong. Maybe as we go forward, there'll be better avenues for using this more wisely, especially as some of these stable coins come to the surface and are being used a little bit more effectively.
I mean, it's always struck, sorry about that, it struck me, and money is a very hard thing to understand when you get beyond the surface level. And I think crypto and Bitcoin plays into that. That on the surface you think, well, this is what I use to buy stuff with. Yeah. But then, what does that mean? Why do you trust the dollars in your pocket? If you start thinking about it, it gets pretty unnerving pretty quickly.
Yeah, you're absolutely right. And that's oftentimes the counter argument. That's the argument that, hey, at least we know something about crypto, and why should we trust the dollar or some of these other currencies anymore? It's just fiat money. It doesn't have any, I mean, in the old days, with Bretton Woods and so on, it was tied to gold. So you can literally, in some of these cases, exchange your money for gold. So that's felt a little safer, but you're right. It's essentially based on a system of trust. But then again, I don't have a lot of my investments in currencies either. No, it's primarily other types of assets, stocks and so on. So I figure, hey, if say the dollar were to lose its value, because maybe the treasury were to print up more money, then the stocks would also go up in value in terms of dollars. So that's a way to sort of hedge that situation, I think. Yeah, but my daughter is currently in Buenos Aires, in Argentina, and she feels that impact or that volatility and the declining value of the peso in her everyday transaction. I mean, she was a little worried the other day when Javier Milei won the election, and the idea was that with Javier Milei winning, the Trump administration would support the economy, pump in maybe $20–40 billion to also support the peso. And she said, that means that everything I'm going to buy here now is going to be more expensive if the peso goes up in value. But yeah, it's out there, it's floating. It's all about trust and thinking about the economy and the future.
No, it always, I occasionally, as I'm wandering through a museum and I find myself in the numismatics collection, you know, you look at coins from ancient civilizations and you think at one point this was money. People thought it was valuable. And obviously, you know, you can't walk into a grocery store and buy your groceries with those coins now. So talk a little bit about your academic research now and kind of the relationship between, you know, this book and your writing for a broader audience and your academic work.
Well, I've continued to work on a lot of related things. In the early days, I worked on a lot of repurchases. An early panel mentioned that even repurchases can be associated with tension. And there's certainly a lot of tension between shareholders and executives in those cases. So I worked on poison pills for a while, which was fun, sort of interacting with the M&A world. And then I moved on to a lot of labor studies, where you have this tension between labor unions and executives, where I could see how the executives were sort of negotiating, how they were trying to fool the labor unions for a while.
Right.
It interacts with their compensation also, because what you see is that right before they deal with these labor unions, you'll see that they lower the amount of options that they have, so that essentially they're trying to tell them, hey, we are also struggling these days. It's hard for all of us. And then afterward, they'll jack up their compensation. But I'm oftentimes returning to the area of executive compensation. One study that I think is very fascinating, at least from an academic point of view, is we're looking to see what's happening in the pharma sector. Because in that sector, obviously, there's intense competition. And every now and then, the FDA will point to one company and say, we really like your product. And they're going to give them a breakthrough designation. And that's going to elevate that company compared to everyone else. And we are wondering what's going to happen to all these other companies, how they're going to catch up. And we suspect that based on theory, that they should then grant a lot of options to these executives, and that's what they do. That's what they do. And now they have the incentive to try to catch up again, and they take on a lot more risk, maybe in somewhat adjacent areas, to try to get back to where they were. So yeah, it's oftentimes back to a compensation, but there's always tension showing up.
Obviously, in Silicon Valley, historically, the dream was to found a company and take your company public. That's evolved significantly in the last generation as the number of public companies has fallen by about 50% since 2000. Why do you think we've seen that decline in the number of public companies, and do you think it's at all reversible? I know this is a subject of deep interest to many in the Valley.
Yeah, oh, that's an excellent. I mean, the obvious, or one obvious answer is that being public is costly. Right. It's costly in terms of compliance. It's costly in terms of having to disclose a lot of information that they don't want to disclose, both to maybe investors and competitors alike. So those are probably a couple of reasons. So, and also these days, I think that you can actually, at least in this country, be a private company and you can still raise capital, especially around here.
Right.
My son just went through the Y Combinator, and it was wild to me to see that this little company, of the two of them, he and his buddy, having this AI automation tool thing, that they can go out there and raise hundreds of thousands of dollars that people are willing to invest in these two guys. It's insane. And I don't think that will happen very many other places. So, yeah.
I mean, were you tempted to invest yourself, or?
Well,
I mean, to some extent, you obviously have invested, but
that's what I was thinking. I mean, I always tell people that they shouldn't invest in their own company because they got human capital in that company, right? But in this case, my son's friend had his dad invest $50,000. So I said, okay, I'll put in at least $15,000. So that was my first investment in that sector. So yeah, I am invested in that. So I told you earlier that private equity, But in this case, at least I've reduced information symmetry, and I believe in the two guys. And I can see them working. I'm staying at their place right now, and I see them working into the late hours. So I try to tell them also that you guys got to eat a little better, not pizza and Panda Express all the time. I mean, I'm investing in this company, so I'm going to get you some vegetables.
Talk about the discussion about whether public companies in the U.S. should have quarterly or semi-annual reporting, and what difference, if any, you think that makes?
Well, I think in general, more disclosure is helpful. I think that investors appreciate that. I mean, of course, there's always a concern that some of these companies will be very myopic. But I think that if disclosures happen all the time, to me, I don't think they're going to be more myopic. I think rather, if it happens only, say, every 6 months or every year, they're going to sort of gear up to that particular time, and they're going to be more focused on that one disclosure. So I think that maybe that's going to be even more disconcerting. So having some continuous flow, I think, is safe, even if the quarterly statements are not audited. So yeah, I can understand the concern with the cost of it. Maybe we have to have a new category of private firms, public firms, and sort of semi-public firms that don't have to disclose that much.
I mean, the UK, I believe, still has that concept. They have. It's almost a junior, a junior stock market for smaller companies. I mean, what does the academic research suggest about that approach? Is that successful in incubating companies that ultimately become larger public companies?
To tell you the truth, I don't know. I haven't seen any particular research on that experiment. But I can imagine that it would be a nice pathway toward becoming. I mean, we've had various exchanges with different listing requirements throughout the years. So in some sense, we've had some similar experiences. And now we have also Chinese companies coming in to the NASDAQ market, and they've been granted some leeway in their disclosure. For example, my understanding is that their executives do not have to disclose the insider trading that they engage in. But that also means that investing in those companies is much more sketchy, and those companies have generally not performed well. So I guess there are experiments like that out there where you give some access to some companies at sort of half price.
Was there, you mentioned earlier your fascination with fraud. When you were a student or starting out in finance, was there a particular episode of fraud that you found really fascinating, that made you focus on this?
No, not really. I guess I grew up in the 80s in Norway, and I think maybe what left a bit of a mark was the banking crisis back then. That happened first there, and then it spread to other places as well. So, but there wasn't necessarily a lot of fraud in there, but it left me thinking about the world. Yeah, and reading some of the books about the inside trading in the 80s, that was always fascinating. But again, just small glimpses of what was happening here and there. Ivan Bolsky and some of these guys. Mike Milken with his investment banking firm out there on the West Coast, and how he was dealing with all his M&A transactions, parking securities here and there. That to me was fascinating. But it seemed like a lot of it was on a somewhat lower scale. Yeah.
As you look at various episodes of fraud, what commonalities do you see? I mean, clearly information asymmetry is a huge, is a thread that runs through a lot of them.
Yeah. Yeah, I think we can all have some answers on that. What strikes me in a lot of these cases is how simple a lot of these things are. In the case of option backdating, for example, people asked me, how did it spread? And there was certainly evidence that those companies that were interlocking across the boards, that it was more likely that they would engage in this practice. But I think that a lot of people, as they are granting themselves options, would come to this conclusion themselves. So I think that's what strikes me with a lot of these things, that they are so simple. And from the outside, afterward, we oftentimes ask ourselves, how come we didn't see it? And you first have to be in that situation where you're able to commit that fraud on your own before you realize how simple it is. But beyond that, of course, the one thing that's also common is human nature.
Right.
This need for more all the time, and that need does not dissipate as we get more wealthy.
So we have about 8 minutes left, and I have some more questions, but I'd also like to see if there's anyone in the audience who has a question for Erik. I see. Is that Elena?
I'm wondering, what would be your dream book to publish?
My dream book? Wow.
Well, let me repeat the question. So I captured for the podcast, everyone here. What would be your dream book to publish?
Yeah. Well, the book that I just published was sort of my vision for at least this arena. So this area of forensic finance and forensic economics, I know that forensic economics has a bit of a different interpretation in the legal world. It's more about the tools used to calculate damages and so on. But to me, this was a pretty cool project to work on. The only thing I didn't like about this project was that I was a little constrained in how long it could be. So if I could, I would venture into other areas also, because I think fraud and these tools and so on are used in all kinds of arenas, including sports. Hey, we got sports these days, right? Fraud, you got gambling, you got all that stuff. That's been going on for years and years. The gambling in sports, especially in Asia and in Europe, we've seen it in soccer throughout the world. So that part, I think, would be really cool to write about, and to show also the techniques that we have. There are companies out there that are actually on top of this, that have instituted some of these AI-type tools to try to uncover suspicious behaviors in gambling. Again, that's been around for years and years. There was a Norwegian company that got into that many years ago. So to write a book that encompasses more than just finance, to include also other arenas, sports, chess. Chess is a cool world too.
There's fraud in chess?
Oh yeah, oh yeah.
So talk to us about fraud in chess.
Well, people are cheating.
But it would seem like I mean, you've got a certain number of pieces. They can only move a certain way.
Yeah, but if you play chess online, it's super easy, right?
Right.
Because they got potentially another computer next to them they can these days very quickly and very effectively calculate the best possible move, right?
Right.
And so I'll use that. And then you got fraud detectors on the other hand. They'll try to figure out how often the fractional times that a particular player played the optimal move, up to 100%. If they play 100% all the time, hey, something is going on. Even the best players don't do that. Even my countryman, Magnus Carlsen, he can't get up to 100% very often. So we know that. And if you play in person, there's been a lot of cases where people somehow bring technology into the setting. They bring cell phones. A cell phone these days can host a sufficient amount of power to do these things. You've seen literally pictures being taken of people sitting in the bathroom with the cell phone in the middle of a tournament. So, you might have seen the other day that there was a young chess player who passed away. I think he was only 29 years old. He was actually accused by one of the other former world champion in chess of cheating. And what we're thinking is that the accusations themselves put such a pressure on him that led to his demise. So it's again, I tell you, it's a fascinating world out there.
So this audience is filled with many lawyers.
Yeah.
And we are often considered the guardians of integrity at organizations when we are in-house counsel. Do you have recommendations for us, advice for us, based on the research that you've done?
Oh, boy. I'm not sure if I should give advice to you guys. Yeah. One of the brilliant things about being in a setting like this, one of the reasons why I really like to come out of my academic bubble, is that I get to talk to people like you to understand what's going on in that world. And so I take that back with me, and I get a different way of thinking about this. So I maybe you don't suspect it when I'm talking to you, but I'm trying to give essentially advice to myself. Most of the research I've done is sort of at the very high level, where I can sort of detect that fraud is going on in the larger population. But oftentimes my research is not able to pinpoint exactly which company has done it. I can kind of look at it and say, this is probably a culprit. But I guess if you're looking for fraud cases, you can do something similar. I've certainly helped out some plaintiff firms in the past, identify firms. But the tools I've used have been pretty simple, but they still very much appreciate what I've done for them. So they've sort of gone from one firm to another. For example, there was a whole stream of firms up in Calgary that had done some shenanigans, and there's a lot of money up there, a lot of old money, a lot of nice new buildings and so on, and a lot of fraud in the boardroom. So yeah, I guess if you can put some of your people onto using some of these techniques, then at least it'll help you figure out where some of these problems might be. But beyond that, yeah, I'm hesitant to give you guys advice.
Okay. Oh, I see one.
How do you advise executives to think about executive compensation in a private company, just given the mismatch between private company and public company valuations?
Just to repeat the question, how do you advise executives in private companies to think about executive compensation, based on the difference between valuations in public companies and private companies?
Yeah. Oh, wow, that's a good question. Well, first of all, I don't advise these companies. Rather, I'm working on a project now where I look at a lot of compensation around, especially turnovers and so on, and I'm very curious about what happens with compensation across time from the beginning, then when an executive is hired, and the next several years, because I think that a lot of what happens out there is rather inefficient. For example, I see that a lot of companies give a lot of options to an executive upfront, and then they continue to give them more and more options so that they end up with the maximum number of options about 4 or 5 years in. To me, that's not optimal. To me, it's more optimal to give max incentives to begin with, when there's a lot of volatility and uncertainty in the firm and you're sort of staking out the new course. So I've actually reached out to a lot of compensation consultants to ask them what is going on, why they give this advice. And it seems like a lot of the advice that they're giving is based more on maybe what some of these executives want, because executives don't always want maximum incentives. They want a package that suits them. So they, for example, don't want all the options up front, because what happens if the stock price falls and they don't want to be blamed? They want to know that there's more options coming in the next few years. Again, to us in academia, that doesn't make sense, because you should blame them. They should pay the cost of seeing the price go down. So I would say that with some of these private companies, clearly, they shouldn't rely to the same extent on some of these options, because then a lot of the pricing, including the exercise price and all these other issues, becomes more susceptible to fraud and guesstimates in terms of what the value should be. And you look at, for example, what happens with option grants leading up to IPOs. And a lot of those option grants are happening with exercise prices that are way, way down there. And you wonder, how the heck did they come up with those prices? Because clearly, they're going public at a much higher price. So that looks to me to be fraudulent. And so I guess that's what happens in that private world that happens. So I assume they just should pursue simpler goals, maybe some revenue-based goals or something, and bonus systems, instead of having these option grants and so on. Or maybe just go with plain old stock in the company. But it's a good question, but I haven't had the chance to actually give that advice to anyone.
Erik, thank you so much for coming to speak with us today.
Well, thank you so much. It was a pleasure.
For Drinks with the Deal, I'm David Marcus.